Economic Development of the Conference Board, or CED, and welcome to Policy Watch. Policy Watch is a webcast series designed to connect business leaders to public policy issues of the day. Now, today we will discuss the economic impact of the indexing industry and how it will impact Americans and their retirement in the future. Some of the key questions that we'll be asking today is some basic ones, like what is the indexing industry? Second, how are index funds providing the necessary safety net for a comfortable lifestyle for Americans in the future? And what is the difference between active and passive funds? Now, throughout this broadcast, we're talking a lot of different terms are going to be used that might be very technical in nature, and so I'm going to ask our guests throughout to be a little bit more specific when you hear things like ETFs and what do those things mean. So my guests today will understand that much of the material that we're dealing with today is very complex. Now, before we begin our program, let me tell you a little bit about CED and our history. CED is a center of the Conference Board, and we're comprised of some 165 CEOs from some of the major companies across the country. CED got its start when President Roosevelt was putting together meetings with business leaders about how to move the economy from a wartime to a peacetime economy. In fact, one of our very first policy studies actually became the blueprint for the Marshall Plan. And in fact, Paul Hoffman, the CEO of Studebaker, was the first administrator of the Marshall Plan and our first chairman. Now, for over 7 decades, CED's business leaders have provided reasoned solutions from business in the nation's interest. CED has impacted debates around education policy, healthcare reform, money and politics, and fiscal policy. Now, before we get into the program today, I need to run through a few housekeeping items. You can participate in the webcast today by asking questions via the chat box. Download the presentation via the file download pod in the bottom center of your screen, and view the video or the PPT full screen by clicking the 4 arrows at the bottom right of the screen. Complete the brief evaluation at the end of the webcast so we can incorporate your feedback into future programs. And finally, share this program on demand with your colleagues. It'll be available about approximately 48 hours after the webcast on our website. Now, you can earn CPE credits during the webcast as well. Simply type your full name and email address in the space provided, click OK for the 3 pop-ups that occur during the webcast, and stay online for the entirety of the program. Now, in a recent article in Bloomberg, Peter Coy wrote that Vanguard Group founder Jack Bogle ushered in an era of low-cost investing for the many. He launched the first index mutual fund for individual investors in 1975 for the purpose of passive investing. Skip the stockpiling, save on fees, and simply ride the ups and downs of the market. Coy goes on to write that sometime this year, analysts at Morningstar Inc. Say that the assets in passively managed funds are likely to surpass those of actively managed funds. By pushing down fees across the industry, Bogle may have saved American investors $1 trillion over his lifetime. Now, today, we plan to discuss the indexing industry and what it is and how it's impacting our retirement and our overall economy. Now, we've had some technical difficulties. We have one guest, our principal author of the CED study, Simon Peck, and Simon is the Associate Professor of Design and Innovation at Case Western University. Simon's research centers on the link between corporate governance and organization performance. He is the principal researcher on an upcoming CED study focused on the economics of the indexing industry. Now, in addition, we are supposed to have Rick Redding, who's the CEO of the Indexing Industry Association. And we've had some technical difficulties, so I'm not really quite sure if he's on the line, but Rick has spent more than 25 years in global finance and is responsible for leading IIA's global education and advocacy strategy. Now, gentlemen, welcome to the broadcast.
Thanks, Mike.
Yeah, thanks, Mike. Good to be here.
Great. All right. So I think we've got both of our guests, the miracle of innovation here. Before we get started with our program and our guests, I'd like to poll the audience on two questions. Now, the first question is, how confident are you that you will have enough money to live comfortably through retirement? The answers to that would be very confident, somewhat confident, and not very confident. I'll let you give you a few seconds to weigh in there, and we'll see what our respondents have to say. Give you 5, 4, 3. Okay, just looking at the poll results there, people are somewhat confident that they will be able to live comfortably through retirement, and that's about 60%. Interesting results. Second question then would be, how confident are you that Social Security will enable you to live a comfortable life through your retirement? And again, very confident, somewhat confident, and not very confident. Those results are consistent with what we've seen before, that the guests are not confident that Social Security is going to do it for them. And in fact, we're going to focus, when we turn it over to Simon Peck, we're going to focus on the CED study. And the CED study found that only 17% of Americans in the workforce are very, very confident that they will have enough money to live comfortably through retirement. So people in this country are not relying on Social Security to be their means of support. And it's very clear that our respondents feel similarly. So let's get started with a few basic questions, and I'm going to start off with Rick Redding just to ask him for a few basic questions, and then we'll turn it over to Simon to have him summarize the report that he's authored on behalf of CED. So Rick, it's good to have you back. What are financial benchmarks and indexes, and how are they used and who uses them? Maybe you can kind of start us off that way.
Right. Thanks, Mike. The thing that people, I think, commonly don't understand is almost everyone is either indirectly or directly involved with either benchmarking or indexing in some form or another. And the reason I say that is everyone that works that has a pension plan or a 401k, their managers of those programs are using financial benchmarks for obviously seeing what the results of their portfolio looks like versus a benchmark, or they're actually starting to index products to them. And I think it's appropriate that Simon has started this research, because I think we are at a crucial time where we need to decide how can we save people's retirements, and benchmarks and indexing are a way to help people see where they are, quite frankly. And this is not a new concept. The Dow Jones Industrial started in 1896. So we've had benchmarks for a very, very long time. I think the investor education is just now catching up so people can see where they are.
Interesting. So can you explain to me what is the difference between passive and active investment management?
Okay, so those are the two basic forms of investment. You either hire someone to either actively manage your portfolio. Think about the days when we used to watch Louis Rukeyser talk about stocks that were hot for that week on PBS. Or now what you're seeing, and I think the reason why you did this study was people are now starting to passively invest, meaning that they are following a benchmark of buying every security or a representative sample of securities to passively replicate that index. One of the reasons that that's become so popular is the academic research has shown, and just 50 years worth of experience, it's very difficult for people to outperform the market. And I say that not just for us as retail investors, but also professional investors. They, in fact, don't outperform the market.
Interesting. Okay, and then finally, what are we talking about? Like, how many indexes are there, and how large is this market?
So most people aren't aware, and even people in the professional community have no idea. Our members, we do a survey annually, and our members administer 3.7 million indices. It's a pretty daunting number, but when you think about all the asset classes globally and all the currencies globally and all the sectors, you can start to understand why there's so many. But that gets back to the original question of, is there a difference between benchmarking and indexing? Clearly, the vast majority of indexes are used for benchmarking purposes because, when you start thinking about products, and that's how most people think about indexes. Globally, there's around 7,500 ETFs or exchange-traded funds that I'm sure Simon will talk about. So if there's 7,500 of these benchmarks out there being used for ETFs, and there's 3.7 million, you can clearly see the vast majority of them are used for the benchmarking purposes, not for investable products.
Okay, thanks. That's helpful to get us started. You're going to hear a lot about passive and aggressive types of investment. You can hear about ETFs and mutual funds throughout this program, and I just wanted to get that out in front center so we can then begin the conversation with a little bit more information. So Simon Peck, thank you for being patient. You've just concluded an extensive study through CED on the economic impact that the indexing industry has on the economy. Now, one of the reasons why we hired you was that you don't come from this industry, okay, that you're a thoughtful researcher and that you could provide a sort of independent approach, if you will, to this industry. Before you go through your slides, I'd ask you, what were any light bulb moments or aha moments when you started this research and started to go through the research? Were there moments where you went, oh, I get it, or oh, this is something I hadn't thought about? And then after that, if you will, I'd like you to kind of summarize the study and go through the slides.
Yeah, thank you. In terms of aha moments, I think coming at this as an outsider is just the sheer scale of the industry, really. And Rick alluded to the fact that that they've made investing much more transparent and easy to understand. So taken away some of the mythology of investing in securities, but also their role more widely in being able to set performance benchmarks is significant, and maybe just things that we don't think about. And then finally, just the sheer savings are the dollar numbers are very impressive that investors can have enjoyed just by shifting from one mode of investing to another, really.
Interesting. Well, I come from that era where my father had a pension and he had Social Security, and he didn't really know much about the market, and of course, mutual funds didn't really exist at the level that they exist today. But people don't have pensions anymore, and Social Security isn't as much of a backstop as it used to be. So this industry, that was the thing for me, is this industry has really stepped up and made a difference in people's lives. So Simon, I'm going to turn it over to you and have you start talking about your presentation.
Yeah, thanks, Mike. So, I mean, just to start off, as I say, I think everyone thinks about financial indices. It's how we talk about the performance of markets. We talk about whether the Dow Jones is up or down, the S&P 500 likewise. But they are not, you can't invest in indices. You invest in products that track indices. And for most of us, that means we either invest in mutual funds or exchange traded funds that are designed to mirror an underlying industry index.
So Simon, if I can interrupt you, and I think you have a slide coming up that you can show us, but while you're adjusting that, what's the difference between mutual funds and ETFs? And who creates these financial indices?
Right, great. I mean, so what these two vehicles have in common is that they're both a way of pooling money. So they pool investors' money to invest in the constituents of an underlying index. They do have some differences, however. Mutual funds are what we call open-ended vehicles. And that means that the fund effectively issues new shares every time you invest in that fund. And this reconciliation of new share issuance takes place at the end of every day, basically, and is based on what they call the NAV, or the net asset value of the fund. So mutual funds are open-ended vehicles, issue new shares, valued at the end of the day.
Mm-hmm.
ETFs, exchange traded funds, on the other hand, are what we call closed investment vehicles, in the sense that they don't issue new shares. The supply of shares is essentially fixed, and these shares trade on exchanges during the day, effectively. There's no end of day reconciliation. So they're both vehicles that collect investors' funds and and pool investors' funds. One trades during the day, and the other one settles at the end of the day. Some other differences we can talk about during the talk, but that's basically it. So they have some things in common, but that they are a little bit different. I think this first slide, the AUM, which is just a short an acronym for assets under management, effectively the size of an investment or of a product. And shown here over the last 5 years is that the assets of mutual funds and ETFs have grown from about $13 trillion in the US to about $18 trillion. So we've seen considerable rise in mutual funds and ETFs. Mm-hmm. The orange bar to the furthest left is ETF growth, and I think that's been an important feature of this industry. The significant growth in ETFs, and the yellow bar at the right-hand side is measures the growth of mutual funds that track indices. And again, it's important to note that that as the overall market has grown, we've seen significant growth in index mutual funds as well. Mm-hmm. The grey bar in the middle is what you termed the more active managed sector of investment. That is still dominant. That is still the dominant way that the means of investment. But the funds that track indices have experienced significant growth over that time. I think the next slide may even make this a little bit clearer. Here I actually show what has happened to effectively flows of funds into and out of various ETFs, mutual funds that are actively and passively managed. And you'll see that I can't measure it directly, but the outflow from active mutual funds pretty much we can assume has gone into these more rules-based index tracking funds around ETFs and index mutual funds.
So, Simon, if I may jump in, we had one of our guests who asked if we could briefly explain the characteristics of ETFs again, and that could be for either Simon or Rick. I think we're going to get a lot of these questions throughout the program today because these are some complex issues and topics. So, Simon or Rick, can you just walk us through the ETFs and what are those characteristics?
Simon, I'll let you start and I'll jump in.
Rick, please. Well, so as I say, the ETF trades much more like an equity in a stock, in a regular stock. It's the supply of shares is effectively fixed, and just the buying and selling on the market between market participants determines the price of the ETF. Now, clearly, it's tracking some underlying index, and so that there are mechanisms that mean that they can offer new shares, they can issue new shares if the process of buying and selling moves too far away from the performance of the underlying index. But that's the key characteristic of an ETF. So it's something you can buy and sell like a regular company stock during exchange hours. Again, the mutual fund is something that issues new shares at the end of the day. That sets the price based on the net asset value at the end of the day, and effectively is open-ended. More investment money goes in, the fund issues new shares.
So if I may add.
Great. Simon, anything to add?
If I could add, think of an ETF as a stock, as a single security that trades on an exchange just like a stock. Take that mutual fund Simon was talking about, say on the S&P 500, put it on an exchange just as any stock would trade. I think that has been the fundamental reason why the market has increased so much is, in a mutual fund you can only get in and out at the end of the day. So all the benefits of trading on an exchange are in these ETFs. And the thing that people also don't think about, it's also brought other asset classes onto an exchange. Bonds, for example, don't trade on an exchange, but you can buy a bond ETF that's traded on an exchange just like a stock. So all the protections that the investor gets from being on an exchange are now available for asset classes that have never traded on exchange. So it's been a big benefit. There's a number of other salient features. There's some tax advantages of trading them, for example, but the big way to think of it is just think of it as an index or a benchmark portfolio traded as a stock.
Great. Okay, Simon, back to you and your presentation. Thank you.
Well, I think that's significant. So, as Rick said, there's thousands of ETFs, and they're all tracking. They're all tracking an underlying index, and I think it's worth thinking about how are these indices in one sense created? Because you invest in the ETF, but the ETF is tracking the index, and as Rick suggested, we don't just have ETFs over stocks, equity. There are all sorts of investable securities. It gives you access to fixed income or bond markets, as Rick suggested, to commodities, to currencies. The ETF business really has revolutionized and made access to all different investment classes incredibly easy compared to how it used to be. It used just to be for a very sophisticated investor. So, I think it's worth just pausing a second and thinking, well, let's think about these indices. Who effectively creates the index and how do they do it in one sense? And the Who, as I think you suggested before, was historically started by Charles Dow and the Dow Jones Index, and then it became something that the financial press did. The FT, for instance, created a set of indices to sort of talk about the performance of the market. Then exchanges, stock exchanges, got into creating indices, and now we have some specialist providers that this is what they do. They have particular expertise in the field of data analytics and analysis, and these are the folks that are creating the indices. And I'll say a little bit more about who they are in a moment. The how is also important. I mean, what are the set of rules that determine which securities go into that index? And it's very, very transparent. The how determines, whether we're investing in large companies, whether we're investing in emerging markets, whether we're investing in commodities, for instance. So, there'll be the index will be quite clear about the how. And then one other issue to think about is, well, what is the, and by weighting, I mean, how are those components of the index effectively weighted? And the most common way to do that in most indices that folks invest in is by market capitalization. So in the S&P 500, which is probably the best known index, and certainly the most used in financial products on the equity side. In the S&P 500 index, the components of the index are weighted by market capitalization, meaning that the largest companies have the biggest weighting in that index, and so movements in these companies, if you like, move the needle of the overall index more than smaller companies. So in the S&P 500, companies such as Microsoft, Apple, Google have much larger weightings than companies down 400 to 500, for instance. So that's the who does it, and that's effectively the how they do it. And it's important to think about these when you're considering investing in an index, be that via a mutual fund or via an exchange traded fund.
Excellent.
I think what's interesting as well is one of the reasons why they're so popular. And so this is a graph of effectively the costs of investing in this case mutual funds, specifically equity mutual funds. I guess the good news, just looking at this graph at face value, is that things are going down and to the right, meaning that costs are coming down across the industry for the last, basically the last decade. Well, what's also interesting is that the top line here is the expense ratio, or the charges associated with actively managed mutual funds. And the bottom orange line represents the expense ratio or charges associated with index funds, passively managed.
So Simon, this would be the fees that are being charged. That's the reason for this discrepancy?
Yes. So one takeaway here is that actively managed funds charge more fees than passively managed funds. And and although that gap has shrunk, we're still looking at we're looking at about 70 to 80 what we call basis points, or 0.7, 0.8 of a percent difference in expense ratios between these two mutual fund vehicles, which might not sound like a lot, but that amount compounded over a 20, 30 year period of investing for retirement can very quickly add up.
Right.
You might want to think, well, how do they do it in one sense? What accounts for this difference in effectively fees charged? And I think that comes from a number of from a number of areas. Indices, don't. Once the index has been chosen, that effectively gives the fund, if you like, the ingredients and the recipe, for want of a better analogy, about what goes in that fund. There's no substitutes, if you like. You're being told exactly what is going to be invested in that fund. So you don't have to spend any money doing independent research, effectively. You're not trying to time the market. You're not trying to try and get an edge by choosing different companies. You're spending no money on extra research. You're just mimicking the recipe. So there's a whole set of expenses around, thinking around research on different stocks or entities.
Simon and Rick, if I could ask, and forgive me because I know basic things around this, but can you give me sort of broad examples of active funds and examples of passive funds, or are they all under the same house and it just depends on which one you pick, a passive or an active one? If that makes sense.
Okay. It's a different mindset on how to do it. Active funds, the goal typically is a manager has some sort of advantage or informational advantage somehow to pick stocks that are weighted differently than their underlying benchmark. So for example, the S&P 500 may be their benchmark, but they don't hold their stocks in that same weighting because they believe, for example, technology stocks are a good buy right now and utilities are a bad buy, for example, just a stylized example. That's one of the reasons why, as Simon was saying, the difference in the fees is in a passively run fund, you're not talking to management necessarily every quarter to figure out, wait, you have the next great whiz-bang product. What you're trying to do is you're trying to capture a market segment's return. Whether that's the S&P 500, whether it's a sector or an industry, that's the reason why you do it. Is you might say that none of us really have enough skill to know which technology company is the next great company from an investment standpoint. So why don't I own the sector? Because I think technology is going to go up.
Right. That's helpful. Thank you. Back to you, Simon.
Well, and just to build on that, I mean, in one sense, unfortunately, I think the research evidence suggests that the ability to consistently beat the market in any meaningful sense is not really there. So it's even in the active fund sector. Once you've taken costs into account, once you've taken this differential in costs into account, the evidence suggests that it's just very difficult for the active fund sector to consistently, over any long period of time, beat investing in the underlying index.
Interesting. Okay.
I think so. This is good. This is good news for investors. I think what this means is that because they're not, there's less money spent on research. There's less money spent on trading. There's less so-called transactions costs of buying and selling stock, or securities, thinking about trying to time the underlying asset. And so those are some principal sources of savings. But I also think that clearly the passive sector or the index sector has had a good effect on bringing down costs in the more actively managed sector as well. And in the report, we suggest that these savings to investors are significant. They're something of the order of $50 billion a year. So this is it's a significant sum of money that is being effectively saved by investors and being used to fund their retirements in this case.
Great.
I think another interesting feature that I think relates back to this benchmarking effect that we've talked about is that the number of mutual funds is actually coming down. I mean, it's still significant. We're still sort of, we're talking over 9,000 separate mutual funds. But in the graph on the left here, the number has actually fallen since 2015. And that's significant because normally the number of mutual funds will go down after stock market crashes, after financial crises. And you'll see that dip earlier in the series. And that was around the time of the financial crash. But we've been in a pretty successful bull market for, the last 2 years. And so, this is almost the first time that I think the number of mutual funds has fallen in a bull market. Now, why is that? I think that is because benchmarks and the products that use indices have actually brought a level of accountability and effectively shaken up the mutual fund industry to the extent that if you aren't a mutual fund that can beat the index, you're not going to be able to attract, investor money, and you're effectively going to go out of business. You're going to be merged or liquidated. And so I think that has been a feature of being able to use indices to precision and benchmark in a much more accurate manner. On the right,
Rick, can I just ask you, are you concerned by that decline as the CEO of IIA?
I think what you're seeing, though, is the uptake in the ETFs is basically taking that slack up. And,
right.
And if you don't, not just looking at the number of funds, if you look at the assets under management, that AUM concept that Simon talked about earlier, you can clearly see where the flows are going. So to us, that's not something that's terribly worrying. I think what you see is the market shaking out some, products that probably didn't perform as well as people hoped they would. And now you're starting to see this emergence of the exchange-traded funds.
Great, thanks.
Yeah, and this might be, focusing on the ETFs, as Rick suggested earlier, we're able now to invest in a whole different bunch of asset classes. I think the bond market is an interesting one that you mentioned Jack Bogle in the introduction, and Bogle famously said, in order to prepare for retirement, you should just invest, half in an index equity fund and half in an index bond fund, and then just walk away, just leave it. And ETFs and mutual funds based on the bond market are important. There is the equivalent of the S&P 500 in bond terms is the Bloomberg Barclays aggregate, or more colloquially known as the AG. And the AG is the equivalent for fixed income and bonds, and that has been a huge part of the growth in both the number of indices that are available and the growth in products that track those indices.
Great.
So let me just sort of step back and just think, well, who are the various players here, and please do jump in. I mean, I think, because index funds are effectively price takers and they don't do price discovery. That is the role of the more active fund managers. So that they clearly, even for the index funds themselves, they require people out there having different opinions about whether a security is overvalued or undervalued, and so there is this sort of symbiotic relationship between the funds or the index industry and the more actively managed sector. So people doing price discovery is important. Then we have the exchanges play a crucial role in providing high quality data, or being a way to actually collect and disseminate data. Then we have the index administrators themselves. That's the firms that are actually constructing the indices, who then get used, if they're not being used for benchmarking purposes, get turned into financial products by the fund managers. There's clearly the financial advising industry, and finally, the entities that find themselves in the index. And so I think this figure, shows the the extent of the index value chain, as I call it. We can look a little bit and see who these people are. And sorry, I've got to. Can somebody move the slide, please, if that's possible? Something about CPEs. Thank you.
There you go.
There we go. All right, now I'm back. So who are these companies that are doing the providing these index? And this chart basically shows the index providers for US exchange traded funds. And so virtually every exchange traded fund has an underlying index. And this gives you an idea of who the main players are in this field. I mean, some you may be aware of. We know of S&P. The S&P 500 is the most commonly used index. But, there are some other players, FTSE Russell, MSCI, Bloomberg, Barclays, who I just talked about, and CRISP. And, so these are the players that are actually producing the index. And, it's clearly, an important field. In theory, it's a very easy field to get into, because in reality, what you need is, an idea about constructing an index and some way of doing the data analytics. But in reality, we see that there are benefits to scale in this industry. Mm-hmm. Mm-hmm. The remaining providers, there are plenty of other index players out there. There's about 150 of the others in the US ETF industry. But it's clearly important. It's concentrated amongst organizations.
Great.
And likewise, the market for ETFs is sort of is similarly concentrated. We have the big players. John Bogle's Vanguard is a big player, but the biggest players are BlackRock and State Street, as I suggest here. And obviously these aren't just producing index funds. They also have active management divisions as well. So there is this relationship between the active management sector and the growth of more passive players as well.
Let me ask if I could ask this of Simon and Rick. So what do you think the marketplace has learned since the market events of 2008? I mean, I don't know if there's anything you've uncovered, Simon, in your research. Rick, you're thinking on that as well. But, obviously we went through the Great Recession, and this had an impact on everybody's lives. But what do you think the marketplace has learned since then?
Simon, go ahead. No, I'll chime in.
Rick?
Okay.
No, you can. Well, I think one of the things about, if it hasn't come across, I mean, one of the benefits of products based on financial indices is basically their accountability, transparency, openness. And I think one of the things that drove the financial crisis was that we had products and investment vehicles that nobody really understood. There was a complete lack of transparency and accountability around these things. And so I think this shift towards products that actually have those characteristics is something that has changed since then. And I think the growth of the index industry and products using indices since then is
I would add that as Simon was saying, transparency is key. I mean, one of the things that brought upon the crisis were things like the LIBOR scandal and the Euribor scandal, with very opaque types of benchmarks that no one really knew where the prices were coming from, and there were some conflicts in the chain. So transparency has been key, but also I think technology is changing the market as well, and that just kind of coincides with the market downturn. I mean, I think it's harder for a lot of people and how busy people are to try to figure out whether a certain stock is the next great stock, or do I just want exposure to the U.S. market or the European market, or to smaller things like the automobile sector. And I think that's harder for people to spend the time to do their research. And I also think it's difficult in an age where one tweet can destroy a company's stock value pretty quickly at the expense of others. So I just think it's gotten a lot harder for people to do this, and because people are just so busy in their everyday lives.
Great. Okay, so Simon, if you could just wrap us up with the report and summarize the key findings.
Yeah, I think, just something I hadn't touched on quite as much, but I mean, what I've called here in this bullet point smart beta is an interesting innovation that's going on. And I think I should say that the field of passive investing makes it sound as though it's very reactionary, but I would highlight just the sheer level of innovation that's going on in this sector. And one of these things is around this idea of what they call smart beta. And that's basically, if you recall, I said that most indices are constructed and weighted according to size or market capitalization. There's a whole group of part of the market now is sort of saying, well, maybe we shouldn't really do it just on size. Maybe there are better, if you like, predictors of performance than the size of an organization. And so this has led to the development of a whole new set of indices around other things. And those other things could be almost anything, really. Dividend policy, revenue. It could be almost anything. So there's a significant, I guess I want to say, there's significant innovation in this sector. That's certainly a key thing for me.
Interesting. So, Rick, let me ask you a few questions before we close. I live in Alexandria, Virginia, and that is the industry association capital of the world. Okay, and so I did not know that there was an indexing industry association. I'm pleased that there is. Will you tell us a little bit about it?
It was started back in 2012, and the timing was either brilliant or lucky. I'm not sure, because it was right before the LIBOR crisis. So they could explain the differences of something like LIBOR and the FTSE 100, for example. So the industry was put out there to essentially promote best practices. So they realized that they were only as good as the least, good participant in the market. And so we set out with a set of best practices. Since then, there's an international body called IOSCO that's put out some governing principles as well. There's some European benchmark regulation that's coming forward. So a lot of the things that we do are to advocate for best practices. And as Simon was alluding to, things that we think are very important for investors are transparency. And the transparency that passive investing has brought has really been key, because at least you know what you're getting when you buy something, as opposed to in the days I used to buy, for example, a growth mutual fund, which meant they could probably invest in whatever the manager felt was the growth stock. If he or she got hit by a bus tomorrow, the next person could think completely differently of those stocks. What you get also, besides transparency in the indexing world, is consistency. So if I were to get, if I was a portfolio manager and did get hit by the proverbial bus, Simon could step in tomorrow and run the portfolio the exact same way. So a lot of what we're trying to do is promote these best practices, promote things that get around redundancy. I mean, we live in a dangerous world these days, so it's all about making sure people have accurate information. We also believe that the administration piece should be separate from the investment piece, meaning creating the products. So in IIA, for example, we say you can only be a member if your business is index administration. Independence to us means they don't trade the underlying component securities of the index, nor do they create the product for investors. That allows checks and balances all throughout the value chain Simon was talking about. And by doing that, as we go back to the Dow in 1896, there's never been an issue with one of those benchmarks that's been run independently. because you have those checks and balances along the way.
Right. So I started off this program by citing a Bloomberg article, and I'm going to go back to that same article and ask you, Rick Redding, about this one piece that is cited, that passive index managers have more of an incentive to push for corporate governance reform than the active ones. And here at CED, short-termism is a concern to many of our members, and corporate governance is one of our top issues. Talk to me briefly about why is that so?
The asset managers that do the investing really have an incentive to make sure the companies are looking longer term, because typically they're going to hold the securities for as long as they have the assets. So it's not like an active fund that's going to say from quarter to quarter say, oh, X, Y, and Z had a bad quarter, I'm going to sell those shares. The only time an index fund typically sells shares is when there's outflows of investments. So I was an officer of a publicly traded company for a long period of time. We actually loved the fact that the passive investors were investing in it because they had a long-term outlook, an outlook that was more in common with the management of the company than necessarily an activist shareholder or someone that's just looking at things quarter to quarter. So I think it's actually been a big benefit to a lot of managements that the passive industry continues to get bigger.
So I'm going to close with an unfair question for you both, and that is that with this new emphasis on transparency and accountability, do you feel more confident that a 2008 recession, the way it came, is avoidable than before, or are you dubious about that?
I'm not a market predictor, but I am a student of history. I don't think regulators or politicians can regulate the global macroeconomy.
Right.
There are times when markets get excessively valued and times when they're unavoidably cheap that you want to get into them. So I don't think you can regulate fear and greed, which is a basic human emotion that's been around since all time. I know in my career, I worked quite a bit on the stock market crash in '87. We've had several of those that were supposed to only happen every 50 years, 100 years in my career. So
right.
Unfortunately, right. I think the positive on this is, on the transparency side, is people now can understand what they're investing in. I think that's a huge benefit to investors. And I think, some of these market downturns and even the LIBOR crisis have actually gotten people to think a lot more about, do I fundamentally understand what I'm investing in? And do I know what they're investing in? And as Simon alluded to earlier, the transparency is there. If you read the prospectus or their information, they'll tell you exactly what the universe of securities is that they can invest in. So I think
Simon,
it's a big help.
Yeah. Simon, any answer to my unfair question?
No, recessions will happen, and I think it behooves us to learn from financial crises, and I think that the revolution that index fund investing is having is certainly to be welcomed. I saw a question there that was coming from Sam saying, are there any trade-offs with these lower fees? And I think not. I think if there was consistent evidence that they weren't worth it, or that active fund managers can consistently beat the index, then that would be another matter. But that evidence doesn't exist.
Well, one thing, if I could add to this, is one thing that we advocate for is for investors to understand. A lot of times, you invest in a product and you don't necessarily understand what the underlying index is. It's worth doing that homework, or having your financial advisor doing that homework, because there's so many products now are marketed that sound very similar that would behave very differently, say in an upward rising interest rate market, for example. So one of the things we really advocate for is, even though there's transparency, the information's out there, please do your homework.
Right. We have about a minute left, and there's a question that came up how much better has passively managed funds performed than actively managed funds? In quick 30 seconds, Rick, what would you think?
Well,
Or Simon?
Simon, you probably have the academic literature right in front of you. I mean,
Yeah, there's very little. I mean, you maybe in a 1 to 2 year period at any given moment in time, you might get lucky with timing. You might jump aboard the next Apple computers right at the right time. But over the long run, certainly if we're talking about saving for a retirement, there's very little evidence that that is the case. And often a lot of these funds aren't worth the
Good.
they charge.
there are active managers that do a fantastic job and do outperform the market. So the story's not just to completely not look at those, because I think the difficulty it is for us as retail investors, it's difficult for us to find those managers on a consistent basis.
Great. Well, listen, I want to thank you both, Rick Redding, Simon Peck, for being here with us today. In spite of some of the technical difficulties, I think we pulled this one off nicely. And I also want to thank you for walking us through a very complex but a very important topic today, and that's really investing in the future of ourselves, but also of our economy. So if you have any feedback or suggestions for future topics for Policy Watch, feel free to email me at Mike Petro. It's MPETRO @CED.org. And remember to sign up for 2019 email reminders. And don't forget to tell your colleagues about our next webcast, which will be on May 2nd. And the topic is still to be determined, but we're going to try to get some feedback from others. So in any event, thank you for joining us today for this program. And again, I want to thank Simon, and Rick for being here today. Thank you.
My pleasure.
My pleasure. Thanks.